Eric, your young, fresh mind, is it a little
Hi
more
guys.
fried? Is it a little more fried, Eric, after, looking for a hard landing and people are saying, "Hey, Eric, uh, where is this hard landing?" And you said to avoid, be risk averse, and the market's rallying to new highs. What do you say to people when they say that to you?
I thought you were going to be easy on me today, Dale.
No, I know. I'm always easy on you, and I'm just saying that I believe you're right. And you know what? We
I'm
all take
I'm just
well,
I'm just teasing you.
well, we all take heat based upon what our convictions are, and at times we may not be wrong, but we may be a cycle early. How are you explaining um, that your numbers, that you're sticking to your guns? And what do you say to people that say, well, you've been talking about a recession, Eric, for, you know, 6, 9 months, real
Sure.
estate
So
crash? Go ahead.
um, the best way to answer that question is just by looking at the data, because we can't. Oops, I think. Hold on. Let me see if I could. Are you guys seeing my slide here?
Yeah, got it. Aggregate coincident index.
Okay. I can't expand it, but I'll
Okay,
just assume
it's
that's
very
good enough.
visible. It's
Okay.
visible.
So the best way to answer the question is just to look at the data, because the data is what it is. We can't really argue it. We can't debate it. It's just a factual representation of what's been happening in the economy. So, as a reminder to everyone who may be new to my process or not familiar what I do, I track business cycles. Business cycles are defined by the expansions and contractions in aggregate economic activity. Aggregate economic activity is defined by the combination of income, consumption, production, and employment. I didn't make up this definition. I didn't even make up this basket of indicators. This basket of indicators is published directly on the NBER website as the collective group of indicators that they use to define the peaks and troughs in the business cycle. So this aggregate coincident index, this basket of income, industrial production, two measures of employment, retail sales, total consumption, we all should be able to agree that this objectively represents the economy in the best possible way, covering all different sectors, employment, consumption, etc. So the reason that I began to uh, say that the economy was in the imminent recession stage last year is because that's what the data showed. So when we look at business cycles, we can define roughly 6 different stages of the business cycle. One of the stages is the pre-recession or imminent recessionary stage. That pre-recessionary stage would be defined by the aggregate coincident index or aggregate economic activity slowing to below trend levels of growth. Trend growth being represented by roughly 2% growth. Now, this data has been revised slightly, but you can see in the chart that the economy slipped into below trend growth in October of last year. So we were growing at 1.9%. Simultaneously, in October, leading economic indicators, which I don't have charted here, but we all should be roughly familiar with things like the Conference Board Leading Index or all of the other traditional leading indicators. In October of last year, all of the leading indicators were deeply, deeply negative. Negative to the extent that is not normally seen outside of recessionary periods. So when
And that
you
was a
have,
low in the stock market last October.
that's right.
So
So
have you
when
ever seen this kind of disconnect between what happens? The stock market's supposed to run on economic fundamentals too, right? Earnings, all of that stuff. I know there's financial engineering to
Sure,
it,
sure.
but have you
So
ever seen a disconnect like this?
yeah, so it's not, I mean, this is I certainly would have expected things to fall apart faster than they have, but this is not really outside the bounds of normal. I'll just wrap up and show you a couple of charts. So basically, the proclamation that the economy is in the imminent recessionary stage is not really opinion driven. It was data driven by the fact that the aggregate economy was below trend and decelerating, and leading indicators were contracting. So if leading indicators are contracting and the aggregate economy is slowing and below trend, that's imminent recession, because your next stage would be coincident indicators like I'm showing here, negative, while the leading indicators are negative, and that's a recession. So when the economy goes into this sub-trend growth rate with negative leading indicators, that's an imminent recessionary stage. And we've been in this stage since Q4 of last year. The growth rate has continued to slow. So all of these narratives about the economy is accelerating, things are improving, it's objectively false, shaped exclusively by market momentum, which I can totally sympathize with. But we have to be careful about following the market and then backfilling an economic narrative. The factual representation is that the economy continues to decelerate since Q4 of last year, remaining in this imminent recessionary phase because leading indicators haven't improved and aggregate economic activity is objectively slowing, although it's taken a number of quarters to slow from 1.5% to zero. So we've only had, basically 30 basis points of decline from Q4 of last year till today. A lot of this is driven by employment, because if I strip out the two employment components and I just hold income, consumption, and production, then we do see negative growth rates. So the call is very much the same, irrespective of the gyrations in the market. And then just before you attack me one more time, Dale, can you see this new slide deck that I'm putting up here? Week 28.
I'm patient. I can wait.
Do you see week 28 here? Or did it not? Let me stop and reshare. Hold on.
You have a good company. Lakshman's work.
I do.
The business cycle. I mean, he's in the same camp as you, and he's seen a few.
Yeah, no, I get it, and I just want to provide some facts for everyone to contextualize what's happening here. So, can you see this long and variable lags?
Got it.
So what this chart is showing is the lead time between when the Conference Board leading index has its peak and the recession starts. And the problem is that we go into this imminent recessionary phase, and it's unmodelable, unpredictable of whether it's going to be a 9-month period or a 22-month period or a 14-month period. You tend to throw your weight in, at least initially, at the average or the median, because that's the most logical place to take a first swing. But it doesn't always mean that it's going to fall on the average. And we're still within the bounds of historical norms, assuming the recession hasn't already begun, which it's entirely possible that it has based on some of the indicators that they use to define recessions. But I want to articulate one point here, Dale, which is that in 2008, it was the deepest recession we've had since the Great Depression. The Conference Board leading index peaked 22 months before that recession started, which was a record. But what's even more difficult about that period is the recession started, the 22-month period was defined by December 2007. But the market in May of 2008 was within 7 or 8% of its all-time high, similar to today. So if you're looking at when the Conference Board leading index peaked to when the market fell apart, the 2008 recession period was probably closer to 30 months. If you look at the time between the first month that the 10-year 3-month curve inverted to when the recession started, we can see that the lags are long and variable. It's 6 to 17 months. We're currently at 9 or 10. But again, the 2008 period was very long, 17 months to the recession start, probably 24, 25 months until the credit events really started to proliferate. And what this chart shows is the monthly performance of the S&P 500 from the day the yield curve inverted, for every single recession. So what this chart is showing is that in 1970, the yield curve inverted. The maximum upside that the S&P 500 had from that inversion point was 0.7%, and then it ultimately had a 30% drawdown. In 1980, the curve inverted, the market went up 20%. In 2008, the curve inverted and the market went up 20%. This is a little bit dated. We're up about 16% now with the NASDAQ up 40. So it's not dissimilar to what's happened in the past. But I want to, again, refocus on this 2008 period to sort of articulate why it's imperative that you remain focused on a data-driven process. Because, Dale, if we go to our leads and lags, you had a yield curve inversion or you had a contraction in leading economic indicators. It took, as we just described, let's say 25 months, and the market went up 20%. So we would have been in a situation saying, hey, this thing's never coming, Eric. You said that the yield curve inverted. This time is probably different because the yield curve inverted. We're 23 months later. The market's up 20%. The cyclical and high beta stuff is probably up 30 or 40%. What recession? Turned out to be the biggest recession we've ever had. All of those conditions were already in place while the market was rallying. So the market momentum is not something that would throw me off my view, since I'm economic cycle first, market second. I'm always going to take my signal from the economic indicators and the economic data. The market will do what it does. It can go up into recessionary periods. It can rally 10, 20, 30% after the curve inverts. And we just have to be really careful that there could be periods where the recession is already baked into the cake in terms of contracting leading indicators, inverted yield curve. It could take 18 months, 20 months, 22 months. The market can rip in your face while that's happening. But you have to, if that's the game you're going to play, have to be nimble enough to recognize that once the curve inverts and these leading indicators contract, your risk reward is highly skewed. Although it's not guaranteed like the 1990 period. But this is the setup that we have.
How are you advising business to prepare for this? You're talking about that, they should be trimming budgets,
it's funny
people from full-time to part-time.
It's a great question. And about half of my clients are asset manager clients, and half of my clients are corporate clients. Manufacturing companies, commercial contracting companies, trucking companies. And if I have 2 calls in a day, Dale, let's say I have 1 call with an asset manager and 1 call with a trucking company. The trucking company is talking about how it's the worst environment they've seen since 2008. They're laying people off for the first time in 20 years, and they're gearing up to potentially liquidate some of their capital goods and trucks because it's a really brutal environment. They have absolutely no disagreement about the recession is fully underway in their sector, and it is, quote from them, the worst environment they've seen since 2008. And I hang up the call and I go to my asset manager clients and they say, hey, what recession? The S&P is up.
Right.
And it's a good reminder that the S&P is not the economy. So what's interesting, Dale, is that the time for my corporate clients to act was in Q4 of last year when we went into the imminent recessionary phase. That's when they should have been trimming their headcount. That's when they should have been thinking about reducing their inventory and capital goods stock. Now it's too late.
I see. So they're hunkering down where
they should have been hunkering down. So, I'm obviously teasing, but when you came on and said, where's the hard landing? Where's that sentiment, and I totally am sympathetic to it, is entirely driven by the whims of the 7 NASDAQ stocks. It's not driven by what's actually going on in the economy, the actual economic data, because the companies that I speak with are absolutely experiencing onset of recessionary conditions already, depending on obviously where they fall in the economy. The trucking and the cyclical guys are obviously on the leading edge of that. So the view on the economy is still, frustratingly or not, that we're still in the imminent recessionary phase. Leading indicators are still declining. And aggregate economic activity, as objectively measured by the index that I showed, is still decelerating, even though it's decelerating at the moment at a snail's pace.
Is the Fed going to compound the problem again this month by raising rates?
Yeah, of course, they're going to raise rates, and that's going to make conditions.
They're anti-growth, aren't they? Because now they have
tighter.
non-inflationary growth happening, right? Inflation's coming down, and well, I'm calling growth, I guess, the S&Ps. But earnings have been okay for a lot of these companies. It's carried the market. So when your asset manager calls and says the S&P, there is no recession, S&Ps, how are you advising them?
Well, I present the data the way that I did, just with
Here.
you, showing them the performance. And look, it's entirely possible that this yield curve inversion does lead to a recession, like every other yield curve inversion. But we have, like I was showing in the chart, a 1990 scenario where your upside in the market does end up being larger than your downside. And you say, well, you're an idiot for not being in the market. But it's not playing the historical odds. And this is not, 2 cycles. This is through inflationary periods, non-inflationary periods. And the extent that the market rallies has nothing to do with how big the decline is. And I would just reframe this chart, which is that the decline is the decline from the day the curve inverts. So if the curve inverts, like in 08, the market goes up 18. This is the maximum drawdown from the inversion point. So the peak to trough drawdown in 08 was more than 43% because we rallied first and then declined.
Right.
So,
okay.
That's how I would be couching the conversation. And of course, we can get into more nitty gritty depending on what assets they manage and things of that nature. But the risk of recession has not been ameliorated at all, despite the market rallying. In fact, it's probably been exacerbated because the Fed, like everyone else, views the S&P 500 as the economy or as quote unquote financial conditions, which has caused them to raise rates more.
This gives them a strong market, gives them more latitude to make mistakes and keep tightening.
I also want to show one more chart at the risk of being,
what?
Making excuses. This chart's a little bit dated. Can you see this one? Stock performance since 10-year 3-month inverted.
Yeah, got it.
This chart's a little dated, but that demarcation line of March 9th, 2023 is an uncomfortable reality. That's just what happened. This NASDAQ is closer to 40% now since the curve inverted, but we would be having an entirely different conversation, Dale, if the NASDAQ was not up 40% in a straight line. And it's hard for me to imagine that the economy's conditions improved and recessionary conditions were avoided because 2 of the top 20 banks failed. We bailed out a couple of tech-related venture funds, and then the NASDAQ went up 40% in a straight line. I wish the demarcation line wasn't March 9th, 2023, but that's just the reality of what happened. So I think we have to separate the speculative forces in the market that can be swung wildly by interventions and bailouts and things like that, all of which is part of the game. We all play the same game, so you have to just take it for what it is. I'm not trying to complain and say that, this is not fair. I think a lot of the things they did in that moment were out of bounds for sure. It is the game that we play, but it's an uncomfortable reality that things were not as they are now up until the day that happened. And then the day that happened, we saw a really significant change in the stock market. So I just want to sort of present all the information so people
It's
can.
almost like SVB saved the market because the Fed injected liquidity because of that. And it found its way into the market.
It could have, it was something related to that. It was something related to that. I mean, it could have been that a couple of large tech-related venture capital funds should have lost somewhere between $1 and $7 billion of uninsured deposits that would have probably bankrupted their entire fund, but they got 100 cents on the dollar.
It's unbelievable.
Look, and look, these are, again, I'm not saying any of this to complain. These are all, we all play the same game and we all have to take these things in stride. But what I'm really trying to articulate here is that we have to be careful about saying, oh, we're not having a recession. The recession has been avoided. Things have been improved because the NASDAQ has gone up 40% in a straight line after a bunch of tech firms got bailed out. The conditions that create a recession, the momentum in the economy, the sequence of the business cycle was unaltered by those events. But there was a liquidity injection. There was certainly a signaling effect from the Fed that despite our tough talk, we may still be there to prevent serious credit events to the extent that we can. And the market is basically saying, in the absence of really harsh job losses, which certainly haven't appeared yet, in the absence of job losses, if I'm looking at the actions, not the words, it looks like we have no job losses and somewhat of a supportive Fed.
Okay.
The
I
job
saw someone
losses,
make
in my
the
view,
point.
are still very much on the way, even though they're, like I was showing in those lead lag charts, they could be delayed longer than average, but it's not, entirely outside the historical range of outcomes.
I read somewhere that the reason the employment numbers aren't changing is that instead of millions of people not being counted as unemployed, they've enrolled on the disability rolls, and a huge increase of people that may have been workers, they're not collecting unemployment checks, they're receiving disability. Would that fuzz up the numbers when it comes to employment?
I think there are a lot of issues with the BLS data in real time. I think it has more to do with coming off of an inflationary period where revenues are high, but production volume is declining. So let's use the example of a car manufacturer, just to make it easy for everybody to understand. Let's say you're a car manufacturer and you have 10 people and you produce 10 cars and you sell each car for $1. So you have $10 of revenue, you produce 10 cars and you have 10 people. What's happening in the economy is we've gone to 5 cars worth of production, but we're selling the cars for $2 instead of 1. So your revenue is the same and you're maintaining 10 employees, even though you're only producing 5 cars now. And the reason that you're retaining the employees is because they were very hard to get. And there's a feeling that maybe in the future, we'll go back to producing 10 cars and we need them. But at the moment, what that's imputing is a collapse in worker productivity, because now you have 10 people producing half as many cars.
Right.
Declines in worker productivity is a leading indicator of employment, because that situation can only last for so long. Volume has to improve, or it ends up eroding your profit margin because you can't pay 10 people to produce 5 cars. So in a well-constructed leading indicator of employment, you would have all of these things that employers would do first. So what I would, and I wish I had a couple more charts to sort of explain this one a little bit more. But what this chart shows is the Conference Board Leading Employment Index. So the Conference Board, they have a leading economic index, but they also have a leading employment index. And what's in the leading employment index is all of the things that you would traditionally expect: jobless claims, hours worked, industrial production, all of the traditional leading indicators of employment. And what I'm doing in this chart is I'm graphing the relative performance, or the ratio, between the leading employment index and non-farm payrolls. So when the line is moving down, that means the leading employment index is underperforming non-farm payrolls, or it's implying that non-farm payrolls will decline. As you can see, every time the ratio in the chart declines a lot, it coincides with business cycle peaks and recessionary periods. The magnitude of the decline that you're seeing here on the right-hand side, if we measure this from peak to trough, the percentage decline, it's been a 7% decline, which is not historically seen unless the economy is already in recession, already losing jobs, except for the 1974 period where we kind of had these levels into the beginning of the recession. The point being is that all of the things that turn the gears of the labor market are turning. What we have is somewhat of a labor hoarding scenario because revenues are lagging because of inflation. We have a little bit of fear that these employees were hard to get, so I don't want to lose them. But as the cycle continues to cycle, the leading employment variables are going to continue to decline. And to the extent they hold payrolls flat, this is going to keep moving lower and lower and lower to the point where they have no choice, but they have to start to get rid of headcount. So when you talked about, have you changed your view? All of the data would have to
I
change.
never really asked you if you changed your view.
So, if
I
I
asked
saw
you
these
what
things,
you hear from your subscribers and people on social media
No,
saying,
I get you.
Eric,
I get you.
the market's gone up and it was a time to not take risk, and risk paid off big.
No doubt. Risk also paid off big in '99 and early 2000. So there's all these times, and I totally get that.
Anyway, what's your
my
self-talk
framework
when you
is that
hear it?
I will change my view when
Okay.
all of these indicators start to inflect upwards. So if I saw leading indicators turn higher, and then I saw aggregate economic activity move from 1% to 1.5% to 2%, clearly we'd be in a new regime. But if my process is based on the sequence of indicators, leading indicators, coincident indicators, and lagging indicators, and the leading continue to decline, the coincident continue to decline, I can't change my view just because the market has gone up. If I did that, I wouldn't really be providing a service to anybody. You can just follow the S&P 500 instead of listening to what I have to say.
Yeah, I respect you for having the conviction not to change your mind based upon the evidence that you see. I just, it's just from someone else who's in the industry. I was curious how you handle that, because I know you're hearing that.
For sure.
You know why I know? Because I'm hearing that. Okay?
Yeah,
I've been bearish, since May. Okay, so go ahead.
I would also say that it depends, and the level of frustration that I sense with clients sort of depends who they are, what they do. So obviously, my non-asset manager clients have no frustration with the economic prognostications. They have frustrations with their business because they're experiencing downturns. Look, if you were outright short the market, obviously that would be a painful experience. If you were just in short-term treasury bills and short-term notes, you're up, 4 or 5%. So you're not down. Your pain is just that your neighbor is in the NASDAQ, right? And, it all depends on how you approach your asset management, what kind of strategy you have. And I think it's really important for everyone to kind of know what their strategy is so that during periods like this, they're not swayed to do things that they do. Give an
Mike
example.
Delfino just said it all. The market is not the economy.
Yeah. And what's funny is that everyone always talks about Warren Buffett. He's outperformed the market over a long period of time, greatest investor of all time. But at these cycle peaks, there's always the article that every single time, has Buffett lost his touch? Because when the market's going up, if you think about it, he's basically a 10-year, 3-month investor. When the 10-year, 3-month inverts, he goes to cash. He waits as long as he possibly needs to. Then the curve blows out and he rips somebody's eyes out. But if I told you, if you look at a 10-year sample of Buffett's performance and he outperformed over the 10-year period, how many of those 10 years do you think he underperformed?
Oh yeah, he rode down. There are a lot of bulls right now that are taking victory laps that stayed bullish all the way through 2021.
Yeah,
during
right.
that decline.
And even before that, right? He was piling cash in 06. He didn't get to rip anybody's eyes out until 09, right? So he was waiting there for 3 years. And I try and not saying that everyone's Buffett, and I'm just contextualizing that if you're playing the business cycle, which is what I do, you have to be prepared mentally for periods that could last, like I showed in the chart of leads and lags. You have to be prepared for 12, 18, 24-month periods of time where the market can be going up and down and gyrating around what's happening in the underlying economy. He obviously has been extraordinarily successful over his career, mainly because his patience is better than anybody else on earth. He'll underperform for 4 years in a row, let alone 4 months. So I think
it helps having deep pockets, doesn't it?
Well, it does, but a lot of it is just that he has had how long has he had $100 billion of cash for? And why hasn't he deployed that? Right. Mm-hmm. So my point in saying all this is that what I do and the business cycle process is not for everyone. It's not for anyone that wants quarter to quarter performance. It's not for everyone that wants every 20% move in Bitcoin or high flying tech stocks. It's really a long-term process. The business cycle peaked in late 06, early 07. Things didn't really bottom until 09. There are obviously repeating examples of these things take 2, 3, even 4 years to play out sometimes. And there are a lot of wiggles in that time period. So if you're going to be a business cycle investor, you have to approach it with that kind of mindset. And you can have a business cycle background and then have some more technical or trading oriented overlays like what you guys do to try and maybe catch some of these fits and starts if that's something that you enjoy doing. But if you're going to use a business cycle process, you really can't expect to get every 2 quarters of moves. And like I was saying, we wouldn't have been having any of these conversations until after March 9th. So we're really talking about, a 5-month period here, and a business cycle process is not designed to catch 5-month gyrations in the market. So it does tend to be well suited for big corporations that turn a big ship that has to move a little bit slower than someone who can move from, maybe bonds to stocks in the snap of a finger.
Well, thank you, Eric, for, fielding those questions. And, maybe it was cathartic to get it out because I know you're dealing with it, and we all do in the industry, and great respect for your work. And next time I have you on, we'll be talking about how you were right, because now it's showing up in the real world.
If not, then I fully expect you to beat me up more than you did today.
You know what?
You'll have to hold my feet to the fire.
Let me tell you something. When I was a kid in grammar school, you'd go out on the playground, you'd have a fight with somebody, and they'd become your best friend.
Yeah.
Right.
Believe me, Dale, I've had you're very nice to me. I've had some less
Yeah.
nice interactions.
All right.
But
All
no,
right.
in truth, all of my clients are always very respectful. This has been a
Yeah.
difficult time for everybody in the markets. So
Yeah.
I'm just trying to explain what I do, and I think it's also important to try and manage expectations around the fact that a business cycle process is not for everyone. If you're not willing to take a multi-year view, you can follow it as someone of interest, but using it for your trading strategy.
Yeah.
If you're trying to trade the jobless claims number, I don't think you'll have a lot of success with that.
Yeah. Well, thank you, Eric, and appreciate you updating us. And I think that you're going to be right. And maybe we needed sentiment to come all the way to there is a no landing. So I think it's going to take Captain Sully to land this plane on the Hudson. So anyway, Eric, thank you very much for your time
Okay,
today,
thanks, Dale. I appreciate
and
you.
all your great edification of our community every time you're here.
Thank you.
All right, buddy. So Eric, check him out at EPB Research, and that's also his Twitter handle. And now you know how to use his information, not for scalping. So you could join the team in 7 minutes on the Morning Edge, everyone. And we'll see you tomorrow to wrap up the week. Don't just count your pips or indicators, count your blessings. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.